You are tuned in to the 5-Minute Signal, Business and Wealth. I am Vivian Thorne, Economic Strategist. This is not a finance podcast. This is a blueprint for building and defending your economic fortress. We don't do speculation here. We do strategy. 5 minutes on the clock. Let's get to work. It is Friday, March 6th, and the aviation sector is currently a house of cards in a hurricane. Yesterday, we watched the Big Three lead a brutal descent, with American Airlines tumbling 5.4% and United following close behind. This wasn't just a bad day for travel, it was a structural rejection of airline margins. While the talking heads focus on the price of crude, the real predator is the jet fuel crack spread. In Singapore, the key aviation hub for Asia, jet fuel swaps have effectively tripled in value over the last 48 hours. We are no longer talking about expensive fuel. We are talking about a total detachment from fundamentals that is making long-haul flight economically non-viable for the unhedged. We are no longer talking about expensive fuel. We are talking about a total detachment from fundamentals that is making long-haul flight economically non-viable for the unhedged. This matters because the airline industry is the canary in the coal mine for global liquidity. When Rothschild Redburn downgraded American Airlines to neutral yesterday, they pointed to a $36.9 billion debt burden and a total lack of fuel hedging. For an airline like American, every 10-cent move in the price of a gallon of fuel can wipe out 25% of their earnings per share. As the conflict in Iran continues to strangle the Strait of Hormuz, 20% of global jet fuel shipments are now in jeopardy. We are moving from an era of cheap mobility to an era of energy siege. And if your capital is tied up in companies that sell tickets weeks in advance but buy fuel at tomorrow's spot price, you are subsidizing a catastrophe. The hard truth is that travel and leisure is the new value trap. Conventional wisdom suggests that after a 5% drop, these stocks are on sale for a weekend bounce. That is a fantasy. The reality is that refining margins have jumped to over $130 a barrel. The refiners, the companies that actually turn the crude into the fuel, are the ones feasting while the airlines starve. The 1,200-point market tremor we saw earlier this week was just the opening act. Today, as the market opens for the final session of the week, the smart money isn't looking for a dip in Delta. They are looking for the exit. To defend your capital before the closing bell today, you must execute these 3 moves. 1. Prune the unhedged. Immediately audit your exposure to the Big Three carriers. Prioritize exiting positions in American Airlines and budget carriers that lack robust fuel hedging contracts. In a high-volatility energy environment, debt-heavy, unhedged transport is a terminal liability. 2. Pivot to the refiners. Instead of betting on the planes, bet on the fuel. Shift capital into U.S. Gulf Coast refiners like Valero or PBF Energy. These firms are seeing 29-month highs in distillate prices and are the primary beneficiaries of the jet fuel jolt. They are the ones capturing the margin that the airlines are losing. 3. Secure defensive retail. Allocate remaining liquidity to essential onshore retailers like Target or Walmart. These companies have the scale to negotiate long-term domestic logistics and the pricing power to pass the invisible tax of shipping and fuel directly to the consumer. They are the bunkers in this storm. Stop betting on a return to normal and start positioning for a world where energy is the ultimate leverage. I'm Vivian Thorne. This has been the 5-Minute Signal. Stay sharp. This program is for informational and educational purposes only. Economic strategist Vivian Thorne is not a licensed financial advisor. This content is not a substitute for professional financial, investment, or legal advice. Always consult with a qualified professional before making any financial decisions.